At what point does it actually start hurting the U.S. economy, or because central banks are there, it won't actually get to that point?
So I actually think we're potentially already seeing it starting to show up in the economic data. We're seeing growth decelerate from the first quarter into the second quarter into the U.S. I think you're already seeing industrial production numbers, which have been softer, capex spending numbers, which have been softer. But I think the real channel that'll be important to watch is the margin line, right? I mean, again, very much as the professor said, this is potentially reversing a 20 or 30-year trend. This is not going away anytime soon. And that's been a 20 or 30-year trend in globalization, which has been structurally fantastic for corporate margins and corporate profitability. If we're talking about reversing some of those cost advantages, then that's going to be something that's not just going to be about the second quarter earnings. It's going to be in the earnings numbers for many years to come.
But does it mean, Andrew, that actually chief executives will just have to get used to it? And so at some point, capex will start picking up again because people say, well, this is a new normal, but there's nothing too worrisome out there? Or are we going to see a kind of, depressed investment, maybe the consumer tailing off a little bit because of these worries?
I think the risks are more to the latter, that it's something that depresses investment on a larger scale, that we've had, I think, maybe without the market fully realizing it, kind of a mini capex boom, a mini tech capex boom over the last 2 years. And so this presents potentially a kind of a catalyst or an excuse to pull back a little bit from that. And, confidence is everything, and for both the consumer and for business. And I think this is one more uncertainty, one more reason not to do something, one more reason to push activity back into a future quarter, which can further slow growth.